What if you lost your investment property tomorrow? The devastating reality is that 80% of Australian homeowners will be tens, even hundreds of thousands of dollars out of pocket. The data from the Insurance Council of Australia shows that most are underinsured and don't even know it. Today, I'll show you how to make sure that you're not one of them. And stick around because you're about to learn exactly how to find the building insurance estimate cost for an investment property in Australia. Coming up in this video, you'll discover why getting your insurance building estimate right really matters, how to actually figure out the right number for your property, and what needs to be included in that cost, including the hidden expenses that most investors forget. Now, here's the thing for most. Insurance is like the spare tire in your car. You don't think about it until you need it. But if it's flat or missing, the whole trip, in this case, your investment property journey, is at risk. Here's why it's important to get it right. If you underinsure, you're exposed to massive out-of-pocket costs when disaster strikes. And if you overinsure, well, you're throwing away money every single year. Neither option helps you build wealth. The key here is accuracy, not guesswork. There are three main ways that investors usually work out this number. The first one, and probably the most old school, is getting a licensed builder to give you a rebuild estimate. Now, this can be pretty handy because it's tailored to your property. They'll walk through, look at the features, give you a sense of what it might cost you if you had to rebuild it completely from scratch. But here's the catch. Quotes can vary a lot. You might get one builder walk in and give you a quote that's 10, 20, 30, even 50 grand different from another. And that can leave you wondering which one is actually right. So while it's personalized, it's not always consistent. The second option is a quantity surveyor or a QS. Now, these guys are the specialists in construction costs. They live and breathe the numbers. They'll factor in every single detail. Think of materials, fittings, compliance costs, everything. And the accuracy is next level. In fact, lenders and insurers, they often rely on their work because it's so thorough. The downside here though is the cost. It's the most expensive option. If you've got a big portfolio or you're the type who wants absolute certainty, well, it can be worth it. But for most investors, the price tag can sting a little or a lot. And then you've got online calculators. And look, these are actually a lot better than most people think. They're quick, they're cost effective, and they're pulling in data from huge databases of property costs, materials, and industry averages. What's great is that they account for a lot of things that most investors don't even consider. Think demolition costs, professional fees, or even compliance with new building codes. It's all baked in. Now, not all calculators are created equally. Some are too basic and some spit out a rough ballpark number that's not super useful. But there's a few out there that dig deeper. One that I like to point out because it actually gets into the details is CoreLogic Cordell SumSure. Now, this one is refined. It doesn't just look at your property, type, size. It really drills into the nitty gritty. I'll leave a link in the description if you want to check it out yourself. And I know that there's buyer's agents out there and other investors that are using this one on the regular. One thing that you should never do, base it off the purchase price. That figure there has almost nothing to do with what it would cost to rebuild the property. Remember, the purchase price is what someone was willing to pay for a property. This price can be either data driven, which is usually the case for investors, or emotionally driven, which is usually the case for owner occupied properties. Now, when you're working out the cover, the right cover, it's not about the building itself. And this is where a lot of investors trip up. They go, okay, place burns down, how much would it cost to put it back up? And yes, that's a great starting point. But a proper estimate has to include three big things. And if you leave one of them even out, then you're opening yourself to a nasty surprise. First, let's talk about the rebuild cost of the actual property itself. This is the obvious one. The bricks, the mortar, the timber, the roofing, and all the actual construction costs to bring the place back to what it once was. Most people, they stop here. They look at the house and say, yeah, it's a 3-bedder. Maybe about this many square meters it should cost, roughly X to rebuild. But in reality, that's just one piece of the puzzle. The second thing, and this one catches people out, is the professional fees and the compliance costs. Think about it. If your place, God forbid, was wiped out tomorrow, you're not just paying tradies to throw up walls and a roof. You're going to need an architect to redesign it, engineers to make sure it's structurally sound, and you'll have to meet today's building codes, not just the one from when the property was originally built. And building standards are always moving forward. More energy efficiency, stricter safety measures, new council requirements. All of that adds up, and it can be easily run into tens of thousands of dollars. And finally, this is the one almost everyone forgets about, the demolition and the site clearance. Before you can even think about laying new slab, you've got to clear away what's left of the old one. And that means heavy machinery, labor, dumping fees, and none of that is cheap. It's not just knocking down a place with a sledgehammer. If you're in a built up area, there are access and safety costs. Clearing a site properly is a big job. So those three things, the rebuild costs, the professional fees and compliance, and the demolition and clearance, that's the full picture. And when you add them all up, it's usually way more than what most investors originally guessed. But if you don't account for them, that gap there is usually where you'll get stung. Here's exactly what happens. Most investors don't even think about insurance until the very last minute. The bank comes and says, hey, we need a certificate of currency before we can settle. And suddenly it's a mad scramble, it's a mad rush. You're rushing, you're stressed, and you end up just grabbing the first policy that ticks the box. And yeah, technically the bank's happy, but is your property actually protected the way that it should be? Well, probably not, and that's risky. The smarter play here is start the insurance process earlier. The moment you've secured your property, start looking into insurance. Don't wait for the bank to force your hand. When you do it early, you've got breathing room. You can shop around, compare different policies, ask dumb questions, because let's be real, insurance jargon can be confusing. And make sure the cover that you're paying for actually suits your property. Here's what happens when you do this. Number one, your property portfolio is protected. You know your property is covered properly from day one, and that peace of mind is massive. Two, your costs stay efficient because you're not in a rush. You're not just overpaying to get it done quickly. You've had time to compare, to check inclusions, to make sure that you're not throwing away money at cover you don't actually need. And three, you position yourself as a confident investor, not just a cautious buyer. And this is important. Confident investors don't wait for other people to tell them what box they need to tick. They take control, they make informed decisions, and that's the difference between just owning a property and actually building a portfolio. So don't leave insurance until the 11th hour. Start early and set yourself up way better in the long run. So now you know how to work out the right building insurance estimate, and you can see why it matters to get this right early. But here's the thing. Having an estimate is only half the battle. The real question is, how do you choose the right insurance policy for your next investment property? That's exactly what I cover in my next video, how to choose the right investment property insurance. Click here to watch it now, and I'll walk you through what to look for, what to avoid, and how to make sure that your investment is fully protected.